Good morning, everyone, and welcome to Robson Laidler's summary of the Autumn Budget Statement 2021 on Wednesday, 27th of October, just ahead of Halloween. The Chancellor of the Exchequer delivered the Autumn Budget announcement. We ask whether it delivered tax tricks or tax treats. Amidst a large portion of hyperbole and bombast, the Wednesday's budget announcement trumpeted a new age of optimism, but there were ominous signs of tax increases to come. Tellingly, we were told that this new age will only be limited by the effort we are willing to put in and the sacrifices we are prepared to make. Although it was optimistic in tone, there were frequent reminders to challenging times ahead, i.e., tax increases. So what did we learn from the budget? It was more spend than tax on the day, as the speech was relatively light on new measures. And especially, it was very scarce in terms of new tax policy, which had not already been announced to the press. The cynical amongst us may speculate that the increases to national insurance contributions announced in early September were a means of softening the blow of a budget that offered very little in terms of new tax breaks or savings. "2021 will go down as a record-breaking year for tax-raising measures, with increases to the rate of corporation tax, freezing of key tax allowances, and thresholds announced in March, plus the introduction of a new health and social care levy announced in September. So what are the main taxes to be aware of for the year ahead? In this presentation, I am going to look at the tax rates for employment, business, and individuals. In September 2021, the government introduced a new health and social care levy, which would be ring-fenced exclusively to provide for health and social care. In its present incarnation, the levy will form an increase of 1.25% on national insurance contributions. However, from April 2023, it will be legislated separately. The mixed increases will affect both the self-employed, employed, and employers, and all working adults will pay the levy, including old age pensioners. Now, this is quite interesting and perhaps sets a precedent for state-aged pension workers to be subject to NICs when they were previously always excluded from this tax. This is a relative 9 to 10% increase in NIC. There will also be a 1.25% increase to dividend rates from April 2022 onwards. Although this is not an employment tax per se, it will affect company owners whose remuneration consists mostly of dividends. I'm now going to pass you on to my colleague Graham Purvis, who will talk in more detail about the extraction of profits from companies.
Thank you, Carrie-Anne. So we've seen that there are increases to the national insurance rates, together with increases to dividend tax. So a lot of SME businesses, family-owned businesses, have remuneration strategies for the director shareholders, which consist of essentially a small salary complemented with dividends. So let's just have a look at now what that means for what the national insurance rate increases and the dividend tax rate increases mean for profit extraction when looking at taking money out of your limited company. So when we look at this, and we also tie in a third change, which is from the 1st of April 2023, which is the increase in corporation tax rates. We look at an overall tax rate position. So what we're doing here is we're considering the impact of the increase in corporation tax, the increase in the NI, and the increase in the dividend tax rates. And when we look at all those things combined, from the 1st of April 2023, when you are looking to take additional monies out of your company at your marginal income tax rate, dividends are no longer as tax efficient as bonus, except if the recipient is a basic rate taxpayer, where dividends will still remain to be beneficial from a tax perspective. So what we're looking at here is your marginal income tax rate, your top rate of tax, and it's looking at taking out additional monies. So I've just moved to the next slide. So let's look at an example here. So this is a business where you've already got your standard remuneration package, okay? And you've had a good set of year-end results or interim results, and you want to take, say, in this example, £20,000 out as a further bonus or dividend, essentially as further additional remuneration. So we're looking here, remember, at the corporation tax rate, the personal tax rates combined. This is an overall tax position, okay? So if we were looking at doing that right now, today, okay, we've got 20k in our company. If we paid that out by way of bonus, we would be left with, after all the taxes, corporation tax, NI, personal tax, 20% taxpayer, 11,724, a 40% taxpayer, 10,320, and a 45% taxpayer, 9,420. Okay. If, as an alternative to taking that as bonus right now, we took it as dividend, you can see by this column here that you would be left with more after-tax money in your pocket, significantly more, especially at basic rate. Still better off 40% taxpayer and still better off as a 45% taxpayer. That's where you are now. So if we look at the position from the 1st of April 2023, when the corporation tax rates come in, the new corporation tax rates come in, and what we're looking at here is, I'm assuming that your company is earning profits of between £50,000 and £250,000. So that your marginal tax rate, the corporation tax it will pay on the level of profits within that range, is 26.5%. Okay, and we can see that looking at the same principle, looking to take £20,000 out in 2023, our bonus, if we took it out by bonus, would be slightly worse off than we would be currently. That's something like a 1.9% increase in the marginal tax rate. There's a 40% taxpayer taking out by way of bonus. Again, slightly worse off from where we were currently, or where we are currently. That's a 1.6% increase in the overall tax rate by taking out as bonus as a 40% taxpayer. And a similar increase in the marginal tax rate, 1.5% for a 45% taxpayer. So you are left with 9,116, as opposed to, if you took that money out now, 9,420. Okay. And then we can see, if we took this out by way of dividend, you can see that from 2023, again, reiterating the point, dividend is beneficial where you're looking at a basic rate taxpayer taking monies out where the recipient has total income of less than 50k. However, when you get up to your 40% and 45% bands, you can see that you are worse off in terms of, you start off with 20, you are left with your hands, left with an amount net in your hands of 9,874, which is less than 9,998 if you took it out by way of bonus. And similarly for the 45% taxpayer, again, marginally worse off by taking out by way of dividend. Okay, so this is illustrating the point that if somebody is on a remuneration package, okay, and you're looking at an additional remuneration, an additional bonus, you would take it out by way of bonus rather than dividend. Okay, but there is a fundamental point that I want to get across here, and we'll talk about that on the next slide. Just before I move on to the next slide, if the company had it profits in excess of £300,000, i.e. it was paying corporation tax at 25%. Remember, these figures are on the marginal rate where the profits are between 50 and 300. If you're taking profits out where the company's paying 25%, these rates flatten a little bit so that it's more or less the same in terms of whether you took it out by bonus or dividend, more or less the same. I think a slight benefit, like less than 0.1% benefit by taking out by way of dividend. Okay, conscious that a lot of these figures are flying around here, but hopefully that gives you the general concept. However, as I said, I want to just make a fundamental point here that when we're looking at the previous slide, that's talking about taking an extra slug of money out, an additional bonus, an additional dividend. How does the changes impact on a total remuneration strategy? Okay, and so what this slide is showing is that low salary dividends mix for taking your money out of company still will leave you better off. Okay, and this is because of we're using up in that strategy where it's a total strategy, we're using up basic rate bands, and as the previous slide said, the savings are still there by way of dividend. Okay, so what does this table show? This is essentially a table where we're looking at various levels of gross salary, okay, ranging from 30k up to 185k, and this is what would happen if we paid it as bonus, and it is if we paid it as dividend. And this is what you would be left with as an individual, money in your hand after all tax and NI is taken off it. So on a 30k salary, you would be left with bonus of 24k, you'd be left with dividend of 27. Okay, and you can see going down this table, you can see that this dividend mix strategy still leaves you better off. Okay, significant sums of money here. You know, you're talking 5 figures in some of these these bigger remuneration figures. So that's where we are today, dividend beneficial. Let's look at the position, not from April 2023 when the corporation tax rates come in, but let's look at the position from next April when the NI has increased by 1.25% across the board, as Kerry-Ann showed in the previous slides, and also where the dividend tax rate has increased by the same amount, 1.25%. Okay, so on these figures here, what we're looking at is the company is still going to pay you a 30k gross salary. Okay, it's still going to pay you a 45,000 gross salary, etc., etc. If it pays you a 30k gross salary from 1st of April 2022, it will cost the company £183 more cost to the company in providing this individual with a 30k gross salary. As you can see, they are worse off with that fundamentally because of the NI rates. Okay, and again, that pattern goes across the board. 45k, costs the company £361 more to pay somebody a 45 grand gross salary, as it did pre 1st of April 2022, and the individual ends up with less than what they currently do. And you can see that pattern goes right through the ranges here. Worse off, worse off, worse off, worse off. Increasing costs for company of keeping that 90k gross salary. Of course, the company doesn't need to take on that increased cost. It could just keep the cost as it is now, the cost of the company as it is now, but these amounts here for the individuals in terms of take homes would be much reduced. Okay, so what this is showing is that, okay, it's going to cost the company this amount more money per individual to pay this amount of equivalent gross salary. Because we're paying more, then we've got more to pay as dividend. And you can see that in this situation, yeah, okay, there's a diminution in take home, but not significant in the dividend strategy. You know, what's that? 11 quid there. You know, 50, 60 quid there, 170 quid down there. So you can see that, okay, what will happen is it'll going to cost the company more to keep you on these gross equivalents. But if you pass that cost, you know, the company endure and take on that cost, pay more out in terms of overall remuneration strategy, you can see that despite the previous slides, you more or less stay with where you are now in terms of net take homes by way of dividends. All right. And so what happens when we come to April 2023, when the corporation tax rates come in here? Okay, the increased corporation tax rate. So this is just the figures from the previous slide. This is where we're at in April 2022. Obviously, the bonus take-home figure is exactly the same. Nothing changes there. I mean, it's likely that there will change in reality. There'll probably be a new set of NI threshold rates coming in April 2023, but I've just assumed the same rates as we currently have. So the bonus amounts stay the same, but you can see that because of the increased corporation tax cost on top of the dividend tax rate, on top of the NI rates, that the company essentially has less to pay to the individual shareholders, and therefore the amounts that they receive in terms of take home from April 2023 is, you know, reduced by thousands rather than hundreds. Okay, 25, 27, 37, 40, 48, 51, and so on. All right, so it's still, you know, it's still beneficial. If you look at these figures, you've still got these figures are still more than what the bonus would be. Okay, they're reduced, but you still get more net take home pay by way of dividend because you're utilizing basic rate bands. Okay, and I just want to make that, again, sorry to labor the point, but when you're looking at a top slice of additional income that you want to take out on top of your remuneration strategy, then yes, bonus, dividend, more or less the same, no benefit in choosing one over the other. But where you're looking at a total remuneration strategy, the low salary with dividends still will give you more than what you would get if you just paid the same amount as bonus rather than as a salary, rather than low salary dividend mix. Okay. Now, the additional thing which I haven't added into this slide is in all of these scenarios, the company saves money. Okay, it saves money because of the corporation tax saved, essentially, because the company in this example is paying 26.5% being the marginal corporation tax. Remember, that's on profits between 50 and 300. And so it saves money. So what the company can do is it can keep that saving and the individual ends up like this, or it can just increase the dividend, and these figures on the slide, but more or less you increase the dividend from the monies that the company has saved, and you end up more or less back to this position here. Yeah. Hopefully that's given you a flavor. I'm conscious that I've bombarded you with figures on that. I think in summary, you know, come and have a chat with us, because it is a modeling exercise. It is looking at personal bespoke circumstances and looking at a strategy which ticks all the boxes for you. But hopefully these couple of slides are giving you an overall feeling that, you know, with a bit of planning and company sharing the cost with director shareholders, which is the normal, the normal working relationship in the SME family managed sector, that the dividend increases and NI increases aren't or may not be as horrendous as one might have first expected. Okay, that's it from me. I'll hand you back now to Kerry-Ann to complete the rest of our presentation.
Thank you very much, Graham. So, in terms of other employment taxes to be aware of, there will also be an increase to the national living wage from £8.91 to £9.50. This is an increase of 6.6%, and the government predicts that the rise represents an increase of about £1,000 a year for a full-time worker. Individuals receiving universal credit are currently affected by a tapering measure. So for every £1 an individual earn, universal credit is reduced by 63 pence. In the autumn budget statement, the Chancellor of the Exchequer announced that the taper rate will be reduced to 55% going forward. Okay, so moving on to corporation tax. The spring 2021 budget announced the main corporation tax was due to increase from 19% to 25% from 1st of April 2023 onward. This main rate of 25% corporation tax will apply to companies with profits of £250,000 or more. Companies with profits of £50,000 or less will continue to be subject to 19% corporation tax. Alternatively, companies with profits between £50,000 and £50,001 and £250,000 will pay tax at the main rate, reduced by marginal relief. An increase of, despite the government maintaining it is the lowest rate of corporation tax in the G7 and the 5th lowest in the G20, an increase of corporation tax of 6% will translate to a significant increase in tax for most businesses. So now I turn to the annual investment allowance. So the autumn budget confirmed the £1 million annual investment allowance would be extended to 31st of March 2023. Under normal rules, all businesses, whether it be a sole trader or a company, benefit from tax relief for investments in plant and machinery used for the purposes of their trade. Plant and machinery includes obvious items such as printing press, computers and forklift trucks, but also extends to company cars and even the air conditioning system of the workplace. Tax relief is typically awarded via a writing down allowance at 18% or 6%, depending on the type of item which is invested. And alongside this, businesses for many years have also benefited from an annual investment allowance, which provides 100% tax relief on qualifying expenditure up to £200,000. This was temporarily extended to £1 million, and the budget confirmed that the 1 million AIA extends to the 31st of March 2023. This goes hand in hand with the spring budget statement, which introduced a new super deduction offering 130% tax relief for qualifying expenditure incurred from 1st of April 2021 onwards and up to and including 31st of March 2023. Qualifying expenditure only includes plant and machinery which would be eligible for the main rate pool and not the special rates or long life assets. The super deduction represents the government's 25 billion investment and in theory 130% relief combined with the current corporation tax rate of 19% means that for every £100,000 you spend, your business would get £24,700 back in tax reductions. However, please note these items are not pooled like other plant and machinery, and companies could be subject to large clawbacks of tax if they sell the items in later years. Finally, let's have a look at research and development relief. So no new legislation was announced. Research and development relief was introduced to encourage businesses to invest in technological and scientific research. So currently, a small or medium-sized company incurring R&D expenditure is currently permitted to claim an additional tax deduction equal to 130% of the cost. Therefore, an eligible company can claim 230% of the R&D expenditure as a deduction in arriving at the adjusted profits for tax purposes. So as mentioned previously, there are no new legislation has been introduced. However, the government has made a pledge to reform the current legislation. So it will be expanded, the qualifying expenditure will be expanded to include data and cloud costs. And support will be refocused towards innovation in the UK. And there will also be a greater emphasis on targeting abuse and improving compliance of the regime. Okay, and now we move into personal tax. So the income tax-free personal allowance will be frozen at £12,570 from 22-23 to the 2025-26 tax year. This means individuals may receive £50,000, £270 of income for these years, which is taxed at the basic rate. Despite fervent speculation, there were no dramatic changes to the capital taxes regime or inheritance tax. It is notable in what has not changed as opposed to what has changed. So I can confirm that the rates of capital gains tax remain at 18% and 28% on sales of residential property and 10% and 20% for all other assets. The tax-free annual exemption of £12,300 is frozen until the 25-26 tax year. And finally, most important, there were no changes to business asset disposal relief announced in the budget. Therefore, if you meet the qualifying conditions and wish to sell shares in a trading company or indeed sell a trading business, you can still benefit from 10% tax on the gain, regardless of your marginal rate of tax. Finally, the autumn budget statement also announced a doubling of the time limit for the reporting of the sale of UK residential properties. In April 2020, a 30-day reporting regime was introduced. Now, this has been a little bit of a struggle to meet these deadlines, and a lot of taxpayers are ignorant of their obligations to file these returns. Thankfully, the government has listened to our feedback, and the time frame for the returns and the payment of tax has been doubled to 60 days going forward. So hopefully this gives you all a little bit more time to report these gains. Inheritance tax, again, very little to report. And the autumn budget statement was more significant than what it admits it's supposed to include. I can confirm the inheritance nil rate band remains frozen at £325,000, and the residence nil rate band remains frozen at £175,000, and that is until 2025-2026 tax year. Okay, moving on. So a note on pensions. At the moment, individuals can access their pensions and a 25% tax-free lump sum at age 55. From April 2028, it has been announced that that minimum age will be increased to 57. This measure affects individuals born after the 5th of April 1973. And just in a few other matters, from April 2023, the government will introduce a new domestic band for air passenger duty with reduced rate and standard rate travel covering flights within the UK. Apparently at the moment, domestic flights we pay double the air passenger duty as we would pay if we were travelling within the EU. In light of Brexit, the Chancellor wishes to change that. It does strike me as slightly ironic that this change was announced less than 1 week before the COP26 convention. But anyway, okay. So, and furthermore, vehicle excise duty for heavy goods vehicles continues to be frozen in 2022-23. The HGV levy is suspended for another 12 months from 1st of August 2022. Business rates. So this isn't something that we often advise on at Robson Laidler, but we appreciate that this is very important for most OMBs. The Chancellor announced reforms to the business rates regulations for businesses in England. So going forwards, more frequent revaluations every 3 years will take place, commencing from April 2023. A new investment relief will be introduced to encourage businesses to adopt green technologies, e.g. solar panels. There will also be an introduction of a new improvement relief. From 2023, businesses will be able to make property improvements and for 12 months thereafter pay no extra business rates. The government also announced that next year's planned increase to the multiplier will be cancelled, and the autumn statement believes that this is a tax cut worth over £4.6 billion. Finally, for 1 year, a new 50% business rates discount for businesses in the retail, hospitality and leisure sectors can claim a discount on their bills of 50%, and that's up to a maximum of £110,000. Okay, and I apologise for that lovely picture of Nigel Farage's face, but also a major reform of alcohol duties is due to take place. Amongst measures such as draft relief and small producer relief, the Chancellor also cancelled planned increases in alcohol duty to take place on Wednesday, the 27th of October 2021. That change is permanent. The budget statement claims that this is a permanent cut in the cost of a pint of beer of 3p. Finally, although the message conveyed in the ex-Chancellor's statement was ostensibly growth up, jobs up, debts down, this really seemed to translate to taxes up, tax rates frozen, tax reliefs down. We could perhaps take a measure of relief from the fact that the statement provided very little tax spooks, scares or surprises. Rishi's closing statement asserted, "My goal is to reduce taxes by the end of this Parliament. Time will tell whether the tax reductions will apply to all taxes or indeed to all taxpayers.